Hey, what's up YouTube? This is Leo with DRIPCalc, and in this video I want to talk about Altria's dividends, and I want to estimate how much they will increase it this year. So right now they're paying, their forward yield is 7.78%, so close to 8% forward yield. But usually in the middle of August of each year they increase their their quarterly dividend. And so as you can see here, last increase was 4.25%. And in the last 2 years, their average increase was 4.35%, and their 10-year CAGR was 7.4%. But since basically COVID began, they slowed down their dividend increases. You can see over here it was growing pretty fast, but then it slowed down. So anyway, I want to make my predictions, but not just like, I throw out a number over there. I want to make a more take a deeper financial look at their numbers, at their recent quarterly results, the future prospects of this company, and if they will be able to sustain the dividend increase. So before we begin, guys, I ask you to smash the like button, subscribe to the channel if you enjoyed this video. Obviously, if you don't, just let me know in the comment section this video is horrible and whatever. And if you like it, let me know also in the comment section. So anyway, let's begin. So right now they're paying 98 cents per share per quarter, and that comes out to almost $4, $3.96, or rather $3.92 per share per year. Okay, so over here they've been increasing their dividends in the last 3 years by 4 cents per quarter, and in this round of increases, I am thinking they will increase it by 3 or 4 cents. I'm leaning more towards 3 cents, and there is a reason for that. So I think their CAGR, their dividend increase rate, will slow down. I mean, it will slow down anyway. Even if they increase it by 4 cents, it will still be lower than 4.25 because you're coming off a higher base. So 4 cents out of 98 cents is lower percentage than 4 out of 94. But so let's take a look at their quarterly results. So we have their EPS came in at $2.21. Now you have to keep in mind, and we'll take a look at their quarterly report, that this is reported EPS but not adjusted. So let's take a look over here at their press release. We need page 4. So this is very interesting information. I'll kind of zoom in. So let's take a look over here. Reported diluted EPS increase was 85.7% to $2.21, primarily driven by the gain on sale of IQOS tobacco heating system commercialization rates. So this was a one-time item. They basically sold commercialization rights to IQOS, and so number one, that's a problem because they were supposed to be commercializing IQOS in the United States themselves. So IQOS is actually a product of Philip Morris, and we'll take a look at Philip Morris. I am actually not sure who they sold it to. I would imagine, because Philip Morris does not do business in the United States. So if you know anything, if you know the history of this company, we can look at the share price, historic share price. Let's go all time. So over here, this huge drop in the share price, this is when Altria and Philip Morris separated into 2 different companies. Basically, it was one company, but then the government sued them, and they separated into 2 different. They divested Philip Morris, which is now called Philip Morris International. So it's basically they sell the similar products. They sell the Marlboros and all those brands, but they sell them outside of the United States. And Altria sells the same cigarettes, but in the United States they produce them. They grow the tobacco here, they produce it here, and Philip Morris actually does not use Altria's tobacco. So they used to buy it from Altria, but as soon as they could, they went with somebody else's tobacco. So the actual cigarettes are not the same because they're not using the same tobacco. But anyway, so Philip Morris, Philip Morris International, they developed this product IQOS. It's a non-combustible hot vapor. It doesn't matter really unless you're a smoker, but basically Altria was supposed to commercialize this product in the United States, and the FDA was taking their sweet time to allow them to do it. And then first they bought Juul, and that was a pretty big fiasco. So if we look over here, just scroll down a little bit and open this cash and debt, you can see over here they bought Juul, and their debt, long-term debt, went from 12 billion to 27 billion. Okay, and they're still trying to pay it off. So let's hide cash over here. Their long-term debt is going down slowly, but the effects of Juul are still there. We're still paying the interest on that debt, and they took a massive write-down on the Juul investment, and that reflects actually in this share price drop right over here. So this is when the news came out. They were at $54, and boom, they went down to 41. Anyway, So back to the earnings report. So this was a one-time item, and the actual adjusted EPS is $1.31. Okay, and so let's go back to the EPS chart over here. So $1.31 is not much higher than their previous quarter, which was Q1, which was $1.21. Now, usually, let's look at the revenue. First quarter of the year is usually the lowest for Altria. So if we look over here, first Q1 of 24, $4.72 billion, and then we go to 23, 4.76, then 22, 4.82. So you can see that Q1 revenue consistently goes down, it drops. Okay, and also if you compare the revenue for Q2 of this year, it's significantly down from Q2 revenue of last year, and then it's below Q2 revenue of 22, and it's significantly below Q2 revenue of 21, and so on. Basically, if you look at the revenue, it's growing slowly. It's been growing slowly ever since like 2009, once they split and everything kind of, settled down. It's been growing very slow, but now the trend is actually downwards in the last 3-4 years. And over here we can see, let's look at this chart right here. You can see net revenue. I think this included the one-time item. It is still 4.6% lower than no, this is net revenue before excise taxes. So it's 4.6% lower than a year ago, and after taxes it's 3% lower than a year ago. So the revenue is going down, and if we look at their presentation, it's actually not looking very good for smokable products. You can see adjusted cigarette decline rates. So for Altria smokable segment, in this year alone, it's down 10.5%. And so what this means for the company is that their revenues are going to continue to decline. And even though their non-smokable products are growing fast, I don't think they're growing fast enough. So if you look at this chart, the secular decline in the quarter was 2.5%, and basically each quarter it's 2.5%, and it will continue going down. So basically, even with the improvement in the non-smokable products of like 14% sequentially quarter over quarter, for example, for Enjoy, that will not make up for the loss of volume and loss of revenue on the smokable side. So back to the earnings and revenue and the dividends over here, we want to figure out how much they will increase the dividend by. Okay, so we already figured out that revenue is more or less stable and with a very slight decline overall, because on one side you have decline in the smokable products, on the other side you have increase in the non-smokable. So anyway, they will most likely increase the dividend, and you can see their dividend safety, like over here, it is around 80%. Now again, this last quarter, because they had a not paper gain, but one-time item, so their safety went down a little bit. Somehow their free cash flow this quarter, so this is free cash flow to dividend ratio, you can see every quarter, every second quarter, it's like negative for them, or like near zero, the free cash flow for this company. So that's why it is negative over here, because we're dealing with a negative number. But typically their free cash flow to dividend ratio is 60%, so it's pretty safe. They can afford to pay the dividend. Now net income to dividend ratio is about 80%, sometimes it goes as high as 95%. So that is dividend divided by the net income, or EPS, that they report. So anyway, can they afford to increase by 4%? Let's take, or by 4 cents. So basically, can they go to $1.02? Now keep in mind, they will have to pay that $1.02 going forward. And if we look over here at Wall Street estimates, basically they're not expected to grow their revenue at all. They're expected to be flat, and same with EPS, same with net income, EBITDA, and so on. So will they have actually room to keep growing their dividends year after year? And so they would probably have to do that at the expense of the share buyback. So basically, by reducing the share count, they have to pay out less dividend. And so if we do the math, if we take 1.72 billion of shares outstanding right now, and we multiply that by 0.4 cents, or 4 cents, we basically have to pay $68.8 million more each quarter by increasing the dividend by 4 cents. So that's almost $70 million that they have to pay in the extra dividends if they increase it, or when they increase it this quarter. So probably it is better to do 3 cent increase, but most likely will be 4 cent increase, because shareholders, they expect the return of equity. So the company, when making the decision to raise the dividend, they have to take a deep look and a very careful look at, can we afford this going forward, because a year from now we'll have to increase it again. People are already accustomed to at least a 4% increase every year. And so what they do is they buy back shares. That's why I brought you over to this chart. And their share buybacks are really great. So you can see in the last year alone, they bought back like 3.6% of their shares. And like a big decline in share count happened this quarter. Although I'm really not a fan of that, because look at the share price. So it happened when the price of Altria went up. So here it was about $44, and it went up to, so the quarter ended around July 1st, so it was in the $45 range. Sure, it's lower than it is right now, but if they did more buybacks over here at the $40 range, they could do it much cheaper. But anyway, so they reduced the total amount of shares by 3.6%. Therefore, they can actually increase the dividend by 3.46% if their revenue is flat. Now, because they still have some room between the dividend payout and the EPS, I think they can safely increase this year by 4 cents. And so I'm thinking that most likely will go to $1.02. Although I think they should, because of the massive declines in the smokable products revenue, they should probably do a 3-cent increase. If we take a look at their dividends, so see over here they did a 2-cent increase from 84 to 86. This was COVID year, yeah, sure. But I think because the decline in smoking rates will continue to persist and will most likely accelerate because there is a very strong campaign against smoking, I think they shouldn't increase it by more than 3 cents, but they will likely increase it by 4 cents. So that's my projection. The next dividend payment should probably be $1.02 going forward until the end of next year, until basically the August of next year, when they will have to do another increase. Well, I say have to because the shareholders of this company are accustomed to return of equity to the shareholders and accustomed to dividend increases. So there you go, guys. Thanks for watching. Now, I've been using our DRIPCalc visual stock research software. If you want to try it, we offer a 2-week free trial, completely free. For 2 weeks, you can cancel anytime. And for our YouTube viewers, we'll offer a 30% lifetime discount. So even when we raise the price, your cost will not change. That will be for lifetime. I will provide a promo code in the description below. And just quickly, we also have this side-by-side stock comparison tool. And here you can actually look at 2 different stocks. So I already preloaded Philip Morris and Altria. And you can see for the most part, they were neck and neck. And total return was rather equal. But in the last couple days, Philip Morris stock price just skyrocketed. If you look over here. So did Altria, but not as much as Philip Morris. And basically here you have all the metrics for each company that you see on the individual stock report, but here they're side by side, so you don't have to switch between windows, you don't have to switch between tabs. We made it super easy to see all the important metrics right in side by side when you compare 2 different stocks, 2 different companies in the same or different industries. So thank you for watching, guys. Smash that like button, subscribe to the channel. Again, the promo code is in the description below and in the pinned comment. 2 weeks free trial. If you don't like it, cancel. If you like it, you get the 30% lifetime discount. I'll see you in the next video. Bye.